Welcome to the Transparent FX Academy. I'm Nick and I'm a top author on TradingView with over 190k reputation points.
In this video, I will be speaking about gold. Now, as usual, to keep the video as educational as possible, first I will be covering the technical aspect for this market. Then we will be moving to the order flow by looking at the commitment of traders, so the COT data, so essentially what hedge funds and the big players in the market are doing and how they're shifting their orders. And by the end of the video, by using a combination of these two different types of analysis, we will try to understand where we have the highest probabilities for the next potential move here for this pair. So this is definitely a video you do not want to miss.
If you're new to the channel, make sure to subscribe. This is the place to be for high quality free trading education. Now, without further ado, let's jump straight onto the charts.
Starting here from the monthly time frame, what we can see is that at the moment, this market is rejecting to the upside the very strong historical monthly support and demand area that I have just identified here. In fact, what we can notice is that this market was already respecting this area as quite strong historical supply and resistance, preceding all these rejections to the downside, and then the market broke above this resistance level with this impulse to the upside and this monthly close here above the level. At that point, as we know in the market, all this previous resistance was turned support, because in the market, previous supply and resistance, once it is broken to the upside, becomes support and demand. The market retested here the level as support and demand and is currently still in the process of rejecting it to the upside, which is exactly what you would usually expect in a situation like this. So from a monthly standpoint, everything seems quite bullish, and there is definitely the possibility of seeing more bullish price action being created away from this level. Dropping down on the weekly time frame, what do we see? Now, from a weekly perspective as well, the situation is quite clear. We had a market which was in this weekly range. We had the top of the range here and the bottom of the range here. Now, until the market was remaining in between these two levels, we were obviously seeing horizontal price action being developed, with the high being respected as resistance in multiple occasions and the bottom being respected as support in multiple occasions. Then the market broke out from the range with this weekly close above that zone, and as we have already seen for the monthly time frame, also here on the weekly, once the resistance level was broken to the upside, it became support. The market retested it as support here and is currently still in the process of rejecting this level to the upside, and we can also notice how it has already created a series of impulses and corrections, so higher highs and higher lows from a weekly standpoint. So clearly we are still in uptrend from a weekly perspective with the creation of higher highs and higher lows. However, it is also important to keep in mind that no market just goes up in a straight line. Every uptrend will have a series of impulses and corrections, which is in fact exactly what the market is also doing here. And the last move was an impulse to the upside. So the next logical step would be for this market to create a correction before then continuing higher. So let's keep in mind that in the short term, there is definitely the possibility of seeing some potential short-term bearish price action being created before then getting a potential move higher. Dropping down on the daily time frame, what do we see? Now, from a daily perspective, what we can notice is that we just had a huge impulse to the upside. Now, the last move to the downside was exactly this one here. So if we have to measure our Fibonacci extensions of this move to the upside, what we clearly have to do is take our Fibonacci from the low to the high of the previous move to the downside. This shows us how essentially we have the minus, so the extension of the 0.618, which is currently exactly at this level. So this is definitely a zone inside of which there is the possibility of seeing a potential reversal to the downside. We also can notice how in creating this push to the upside, the market has created this overextended W formation. And after the creation of a W pattern, as explained many times, there is an increased probability of seeing a potential rejection to the downside. Most precisely, our first potential downside target would be the 0.382 of the Fibonacci taken on the impulse leg, which in this case is exactly the 0.382 of the Fib taken on this impulse leg. So let's keep all of this in mind and go and see what we have when it comes to the commitment of traders. So what the big players in the market are doing. So essentially the non-commercials, so big speculators that are in the market just for profit. So essentially hedge funds and big speculators in the market. Now, if we're looking at data for gold, what we can see is that with the last reports, we went from having 315.3k net positions down to 286k net positions. This shows how institutions have been decreasing their longs that went from 387k down to 357k, and shorts are slightly getting increased, going from 70.7k to 7160k with the last report. So it seems like institutions have been decreasing their longs and increasing slightly their shorts with the last reports, which increases the probabilities of a potential correction to the downside after this massive impulse. Now, by the way, if you still haven't, make sure that you join my free Telegram channel, which you find linked in description, so you never miss new updates. Now, back to the analysis. So in a situation like this, what would I expect? Well, as usual, trading is reactive and not predictive. The monthly, weekly, and daily timeframes combined with the COT data, those are the best timeframes when it comes to the directional aspect of the market. However, when it comes to identifying early shifts in the trend of a market, the best timeframes for that are the intraday timeframes, so 4 hour and lower. Therefore, what I would expect is that if this market would shift from an intraday bullish to bearish market, at that point, I wouldn't be surprised to see a potential rejection to the downside for the market to retrace at least to the 0.32 of the Fibonacci taken on the impulse leg. That definitely wouldn't surprise me. Now, if you want to learn more, I really suggest that you go and check out the transparentfxtrading.com website, which you find linked in description. Here, you have the possibility to gain access to the most complete mentorship program ever that I have created. You have the possibility to gain access to all the courses, the trading station software with the Telegram signals integration, one-on-one private mentoring directly with me, the COT data software that you see me use in all these videos. And if you continue to scroll down the website, past the testimonials, you will see that you have the possibility to join and gain automatically access with the email and password that you will create during the sign-up process. So I really suggest that you go and check it out. The link is in description and I will see you in it. If you enjoyed the video, make sure to drop a like and also let me know in the comments below any new pairs or topics that you would like me to cover in the next videos. And I will see you in my next breakdown.